Hello, everyone. Welcome to the market opening bell for Thursday, March 13. The tariff war continues to escalate. On Wednesday, Canada announced it would impose a 25% tariff on US goods worth 30 billion Canadian dollars, over 20 billion US dollars, in retaliation to the punitive steel and aluminum tariffs imposed by the Trump administration, which took effect on Wednesday. The European Union has also introduced countermeasures planning to levy tariffs on 26 billion euros worth of US goods starting next month. Hong Kong stocks have fallen for four consecutive days. The Hang Seng Index opened 77 points higher on Wednesday, climbing 179 points in early trading to a high of 23,962 before retreating. It later dropped 418 points to a low of 23,363, closing the day down 181 points or 0.8% at 23,600, a cumulative decline of 769 points or 3.2% over four trading days. The H-share index fell 73 points or 0.8% to close at 8,682, while the Hang Seng Tech Index dropped 121 points or 2% to 5,845. Total market turnover for the day reached 278.4 billion Hong Kong dollars. Mainland Chinese market saw an initial surge followed by a pullback. The Shanghai Composite Index peaked at 3,392 but closed at 3,371, down 8 points or 0.2%. The Shenzhen Component Index hit a high of 10,939 but closed at 10,843, down 18 points or 0.17%. Combined turnover for the Shanghai and Shenzhen markets total 1,683.7 billion yuan, up 201.9 billion yuan from the previous day. The midpoint exchange rate of the Chinese yuan broke through the 7.17 mark against the US dollar, reaching 7.1696, a 45 pip increase from the previous day in a 1 week high. In the Hong Kong market, the auto sector performed strongly. Great Wall Motor surged 12.7% after announcing its 2025 Tank 300 model with a starting price of 199,800 yuan. Reports indicate that the Tank 300 received 19,700 orders within the first 24 hours of its launch. Great Wall Motor boasts a robust product lineup this year, including key models such as the updated Wei Gaoshan 2 to 3 SUVs, the second generation Haval Xiaolong Max, and other off-road SUVs in the Tank series. German automaker Mercedes-Benz will introduce smart vehicles equipped with her-size LiDAR technology to the global market. This news fueled a 50.4% surge in her-size US listed shares on Tuesday, which in turn lifted Hong Kong listed RoboSense. RoboSense peaked at 50.8 Hong Kong dollars yesterday and closed at 45.2 Hong Kong dollars, up 2.25 Hong Kong dollars or 5.2%. Hesai Technology and RoboSense are two major competitors in China's LiDAR industry, both focusing on developing and expanding LiDAR technology for autonomous driving and smart mobility. Dubbed the twin giants of China's LiDAR market, their products are widely used in smart vehicles, robotics, and other high precision sensing applications. While the target markets overlap, they differ in technological approaches, business models, and listing strategies. Hesai Technology was founded in 2014 and headquartered in Shanghai. It became the first Chinese LiDAR stock on Nasdaq in February 2023, ticker HSAI. Known for high-performance LiDAR like the AT128 and Panda series, Hesai serves numerous domestic and international automakers and tech firms. In 2023, it achieved rapid sales and revenue growth, but faced margin pressure due to a price for volume strategy. RoboSense was founded in 2014 and headquartered in Shenzhen. It listed on the Hong Kong Stock Exchange in January 2024. Focused on cost-effective LiDAR solutions like the RS LiDAR M1, its clients include Leap Motor and Xpeng. Technologically, Hesai targets the high-end market with products emphasizing high resolution and long range detection for level 3, level 4 autonomy, while RoboSense prioritizes cost control, offering products suited for mid to low end models, example L2 plus autonomy, to scale down prices. Both companies face intense pricing pressure from automakers, a common challenge in the LiDAR industry where profit margins are broadly constrained. Company earnings note: Swire Pacific A and Orient Overseas will announce their results today. US stocks showed mixed performance on Wednesday. The Dow Jones Industrial Average, after falling as much as 423 points, recovered to close down 82 points at 41,350. The Nasdaq rose 212 points or 1.22%, closing at 17,648. The S&P 500 index ended at 5,599, up 27 points or 0.5%. The Nasdaq Golden Dragon Index, which tracks Chinese stocks, closed down 1.2% with Alibaba declining 1.35%. The Hang Seng Index Night Futures closed at 23,633, down 6 points, trading at a 33-point premium compared to the Hang Seng Index Wednesday close. In individual stock news, Tesla surged 7.6% after reports that Donald Trump led purchases of its new vehicles, coupled with Morgan Stanley's recommendation to buy the stock on dips. Reports also surfaced that TSMC is considering forming a joint venture with NVIDIA and Broadcom to operate Intel's foundry plants, boosting NVIDIA by over 6%, Intel by about 5%, and TSMC by nearly 4%. Amazon rose 1.2%, Microsoft gained 0.25%, Meta climbed 2.3%, and Alphabet increased 1.9%. However, Apple fell 1.7% after Morgan Stanley lowered its price target. On the economic data front, the US Consumer Price Index annual inflation rate for February slowed down 3% in January to 2.8%, below the market's forecast of 2.9%. The annual core inflation rate eased from 3.3% to 3.1%, the lowest since April 2021, and under the expected 3.2%. Month over month, the CPI rose by 0.2%, down from January's 0.5% increase, the latter being the highest monthly inflation rate since August 2023 and below the predicted 0.3%. Meanwhile, the monthly core inflation rate dropped from 0.4% to 0.2%, also below the market's expectation of 0.3%. OPEC on Wednesday maintained its relatively robust forecast for global oil demand growth in 2025, citing support from air and road travel. In its monthly report, OPEC projected that world oil demand would rise by 1.45 million barrels per day in 2025 and by 1.43 million barrels per day in 2026, both unchanged from the prior month's estimates. OPEC's data also showed that OPEC Plus production increased by 363,000 barrels per day in February, with Kazakhstan recording the largest output gain. International oil prices rose as a result. NYMEX crude oil futures closed at $67.68 per barrel, up $1.43 or 2.2%, while London Brent crude settled at $70.95 per barrel, up $1.39 or 2%. Today's stock pick is China Resources Beverage, stock code 2460. China Resources Beverage is primarily engaged in the manufacturing and distribution of packaged drinking water and beverage products in China. It boasts a portfolio of 13 brands, including Seibong, 日本 Qingren, Mi Shui series, Holiday series, and 左味茶室. Based on 223 retail sales, it ranks as the second largest packaged drinking water company in China and the largest purified drinking water company, with market shares of 18.4% and 32.7% respectively. Leveraging its established brand image in the packaged drinking water market, nationwide sales network, and production capacity layout, the group has strategically expanded into several core categories of China's ready-to-drink soft beverage sector, such as tea beverages, juice-based drinks, and coffee beverages. In 2023, based on retail sales, the group ranked fifth among China's ready-to-drink soft beverage companies, with a market share of 4.7%. The group centers its strategy around the Saibon brand, enriching its packaged drinking water product matrix by diversifying water types and expanding product specifications. This approach covers a wide range of consumption scenarios, including outings, home use, business, dining, and sports. For instance, the group has strategically focused on medium to large size packaged drinking water products. From 2021 to 2023, the revenue and sales volume of its medium to large size packaged drinking water products achieved a compound annual growth rate exceeding 10%, with the share of the group's packaged drinking water category revenue steadily increasing year by year. The group operates 13 self-owned factories and collaborates with 31 production partners across China to produce packaged drinking water and beverage products. With standardized capacities of 18.8 million metric tons and 6.4 million metric tons respectively, it partners with over 1,000 distributors nationwide, collectively covering more than 2 million retail outlets in China. Regionally, the group's packaged drinking water products hold the highest market share in six major provinces: Guangdong, Hunan, Sichuan, Hainan, Guangxi, and Hubei, where the packaged drinking water market accounts for approximately 30% of China's total packaged drinking water market. Additionally, the group ranks among the top three in the packaged drinking water markets of 17 other provinces, which collectively represent about 60% of China's total packaged drinking water market. The group will announce its final financial results for the year ending December 31st, 2024 on March 21st. For the 4 months ending April 30, 2024, the group recorded revenue of 4.149 billion yuan, a 5.3% increase compared to the same period in 2023, and profit attributable to shareholders of 446 million yuan, up 25.2%. The overall gross margin was 47.1%, an improvement of 3.8 percentage points year over year. Suggested buy price 14.4 Hong Kong dollars, target price $15.9, stop loss $13.5. I personally do not hold the above mentioned stock.